Hello and welcome. Today we are diving into one of the most talked about currency pairs this week, USDJPY. There's a lot happening behind the scenes, so let's break it down. So, the Japanese yen finally caught a bit of a breather after weeks of steady depreciation. This has happened because Japanese officials have stepped up their warnings about possible intervention. Whenever you hear Japan say they won't hesitate to act, traders around the world immediately pay attention. On the US side, the dollar has cooled slightly because the Federal Reserve has now turned dovish. Comments from Federal Reserve Governor Christopher Waller and New York Fed President John Williams have pushed expectations of a December rate cut above 80% now. When the Fed sounds soft, the dollar usually softens, but not by much this time, because the yen's weakness is overshadowing everything else. Now here's the twist. Even with the intervention talk, the yen remains under pressure. That's because Japan has just approved a massive 21.3 trillion yen stimulus package. It's the biggest since COVID-19, plus significant tax cuts also. All of these is great for growth but not great for the fiscal health. Markets fear the stimulus will delay BOJ tightening even further, and that combination puts downward pressure on the yen. And with this week being a bit unusual, Japan had a holiday yesterday, which is on Monday, and the US has Thanksgiving and Black Friday ahead, which means liquidity will be thin. That means movement can be sharp, which is exactly the kind of environment Japan prefers when it steps in to support the yen. Now let's examine the charts technically. USDJPY is still riding above its 8-week bullish trend line. The RSI has cooled off but has remained elevated, currently around 64 levels. 158 can be called the next big resistance, and that's exactly where the intervention risk skyrockets. On the lower side, support sits at 155, right on the trend line, bullish trend line, which is highlighted by yellow. So for now, the path of least resistance is still on the upside. Now let's talk about what needs to be done by the importers and exporters. JPY-INR is currently hovering at 56.90, which is a 9-month low. Importers, this is a great window. Hedging is strongly recommended even with higher premiums, because currency is trading at its lower range for the year. Whereas for exporters, you can wait. Levels above 58.50 would be more attractive for selling the yen. That wraps up our quick USD JPY breakdown. Thanks for watching. Stay tuned for more such market updates.